It's the weekend and you have financial questions that need answering. That can only mean one thing. It's time for Jill on Money, the show that takes the mystery out of your finances. Here's your host, Jill Schlesinger.
Oh, welcome to the program. So happy you are joining us. It is always fun. You know, I do a million different things all week long, but I love this show. The original. What year did we start, Mark? 2011 is when we started. Was it the beginning of the year? Yeah, beginning of 2011. Wow. It's amazing. It's gone by so fast. Sort of. Not really. But it's amazing anyway. And it is all because of you guys. I mean, I go out and talk a lot, and Mark goes and gets guests and does all the hard work. But without you, the show is really nothing. So we are so appreciative that you are with us. We're appreciative that you send us your questions, that you come on the air live with us. And that to me is everything. So thank you for that. Okay, maybe you're just listening to the show for the first time. In that case, let me just give you a few little briefings here. This is not a boring financial show. This is also not a show where we're selling a bunch of stuff. Although, don't worry, I'm going to be selling my book like crazy. After the summer, I'll do that. Right? September, I'll start in hard, going after it. But this is a program where we are trying to help you get where you want to go. We're trying to take the mystery out of your financial life. We're trying to help you take control. And the only way we can help you do that is if you get in touch with us. I mean, you can learn from the callers. You can learn from your brethren out there all across this country, sometimes internationally. But the best way to figure out what's going on for you and your specific financial life is to get in touch with us. And we can walk you through that. Just send an email. It's askjill@jillonmoney.com. It's askjill@jillonmoney.com. That's what Chris did. He's going to start the program. Chris from New York City, what can I do for you?
Hey, thanks, Jill. Thanks for taking my call.
Sure.
So my family and I, we moved to New York City about a year ago. Where we lived before, we used to own a home. We sold the house when we moved here, and we look at the real estate market, and we're trying to decide if, A, is it worth it to buy that real estate in Manhattan? We're going to stay in the city probably for 10 years, maybe 15. Or doing online calculators and things, it just doesn't look quite like it pays off as an investment. So if that's the case, then what should we do with this chunk of money that we have left over from our house sale?
Okay, so wait a second. You're not sure whether it pays off as an investment. So I just want to back up there for a second.
Yeah.
In New York, it's very New York City. So everyone outside of New York City is going to find this conversation crazy. But it is true that oftentimes in New York, if you look at a rent versus buy calculator, and there's a really good rent versus buy calculator at the NewYorkTimes.com. When you look at the differential, sometimes buying is really hard. So here's my question to you. You're renting right now. What is the rent that you are paying?
Yeah, it's probably around, it's a lot. It's probably $4,250, $4,500.
Okay, let's call it $4,500. And is that for a 2 or a 3 bedroom?
It's for technically it's a 1 bedroom, a convertible one.
You must be living in a nice area. I won't make you tell me where. And so if you were comparing that $4,500, I mean, by the way, everyone listening right now is like, you're insane.
Yeah.
Okay.
We feel insane.
All right. So if you were going to buy something, what would you have to spend?
Yeah, to something comparable like we have now.
Yes.
I think in minimum probably $1.5 million.
Mark's saying no. Mark, can you get into your building for $1 million or not? Yeah. But maybe you want to live in a specific area. Is that what's happening because you want to live in a fancy area?
Well, no, it's not fancy. It's just that we have a 3-year-old, and so it's kind of all about school. We wanted to go to public school, and the other crazy thing about living in Manhattan is if you want your kid to go to public school, it really helps to live in the area, in the zone for the school,
right?
And those public school districts are just crazy expensive.
How do you feel about moving to the suburbs?
Yeah, we've talked about it. We lived in the suburbs before. We liked it, but we really like Manhattan. My work schedule is kind of crazy and erratic, so it's usually 6 days a week. Some mornings, some nights. Sometimes I'm in town, for all day. From 9 a.m. to 11 p.m. So the commuting would be pretty brutal.
So you've got a 3-year-old in public school. How much do you and you said a wife or a partner? I missed it. Did you say
wife?
My wife? Okay. How much do you guys earn?
A little over $300.
Okay. And you have a retirement plan through work?
We do.
And are you maxing out?
Yeah.
Okay, good. Any debt that's floating around?
No, we don't have any debt.
Fabulous. Okay, so how much money's in retirement savings already?
Probably just a little under $450.
$450. And how old are you both?
I'm 42. My wife's 34.
Oh, very good. Marrying someone younger. Okay, so we got $275,000 in cash, and presumably you're going to keep renting for a while. So let me ask you something, though, for reals. If you could find like a great suburban area, and I'm going to tell you what I'm thinking about here, is that like if in 5 years, maybe your professional life is settled down a little bit more. Maybe it won't be. I don't know. But would you like to preserve the ability within the next, say, 3 to 5 years to buy something outside of the city?
I think so. I think we'd feel good. We would feel better if we just had the option, even if it never happens.
Yeah. I mean, because I think that, there's an inclination that you would have somebody say, give me that $275. Let's put it in the market. It's your supplemental retirement account. We're rocking and rolling. Or let's throw it all into a 529 plan and fully fund your kids' college or whatever. But I just am not a fan of that kind of move, because I think you're going to want to preserve your options.
Yeah.
I think that, today you feel one way about, I guess I've had this conversation with not just, every single friend of mine who lives in the city and works, but many people who are colleagues of mine, and that at some point, even if you feel like there's no way I'm ever going to move to the suburbs, that sometimes there's a moment where you say, you know what? Commuting actually is better because I want a yard or I just want some flexibility, and you might get sick of the city. Who knows? I think that what you want to do is you want to have the money invested, but I think that a chunk of that money has to be kept liquid. You already have an emergency reserve fund, right?
We do.
How much is in there?
About 50.
So in some respects, it's almost like you want to have a separate account for this $275 that is invested more conservatively than you would your retirement account of $400,000, because you really want to be careful. You want to preserve the option of tapping into this money if you found a great apartment, because look, things do happen. Weird stuff pops up. You might find that you're in a rental. Someone upstairs says, "Oh, my friend around the corner is going to do this," and you want it. You're like, "Oh my God, I can actually buy $1.5 million apartment, and it's a nice 2-bedroom apartment, and it's on the Upper West Side. It's Jill's neighbor. It's fantastic." And you find that you don't want to be tied up into a situation where you can't get the money to do that. Okay, we are going to be right back after we take a brief break. But during this hiatus, go to our website, JillOnMoney.com. There you can sign up for our free weekly newsletter. You'll get all sorts of cool stuff, and maybe even a chance to buy the book early. Jill on Money. We'll be right back.
Eight 855-411-JILL. That's the number to call to have your financial questions answered. Back to Jill on Money with Jill Schlesinger.
You're back with Jill on Money. And Mark is making fun of me as we come out of the break because I'm multitasking and he's making fun of me. And that's what he does. Hey, we've got a sister broadcast. It's a podcast. It's called Better Off, and you can get it on Apple, Stitcher, radio.com, Google Play, anywhere else you get your favorite podcast. We'd love for you to subscribe to it. It's a little bit different than this show, but if you like this, you'll like that. I'm pretty sure. Weekly newsletter. It's free. We'd love for you to get involved. All of this is for you. at JillOnMoney.com. Jeff from Georgia is on the line. Tell me what's going on. How can I help you?
I'd like your insights into this particular question.
Okay.
So I'm 52 years old.
Mm-hmm.
I've got a net worth of about $1.7 million.
Ding, ding, ding. Great job.
Bing, bing, bing. Yep. Zero debt.
Mm-hmm.
Within retirement accounts, between my wife and I, we probably have about $750,000 in IRAs, 401ks, that type of thing.
Okay.
I believe there's probably a correction at some point in time, but who knows when and how big.
Mm-hmm.
So one of the things I was thinking about, and this will be maybe a little bit of a speculative play, not something I usually would do, but say out of the $750,000, take some of that, say about $100,000, put it in cash, and park it keep it in one of the 401ks or whatever it may be, until this correction that may be on the horizon happens, and then throw it back in the market then.
Okay. Little market timing for you. How much is in stock versus bond versus any other asset class right now?
I get about $350,000 in maybe $400,000 in real estate.
Okay.
So that's my personal home and some rental properties.
Okay.
We've then got about another $60,000 just in pure cash.
Yep.
And then the rest of it is in mostly probably equities.
Yep.
But in a number of my IRA accounts and 401ks, I've got those. They're the target
date funds. Sure. Okay.
Yeah, exactly.
Okay.
So most of the retirement accounts are in those types of investments.
Mm-hmm.
And if they're not, then they're in an index fund.
Okay. And no bond positions outside of what's within the target date funds, correct?
Correct.
Okay. Let me just roll back one more layer of questions. Sure. Now, you're 52. When do you think you'd like to retire?
I don't think I'd ever stop working. I'd have to do something just to stay sane.
Okay.
But to back out of the professional world, let's say around 60.
Okay. All right, so 60. Let's just say 60 for the heck of it. How much money do you need to live on? What's your actual need in terms of your expenses and what you would expect during retirement? How much money each month or each year? What would you guess?
Yeah, I'm thinking, honestly, my wife and I, we could probably get by around $75,000 a year.
What's your personal residence worth?
About $250,000.
Okay. I am going to pull that out of your net worth because that's not something that I consider to be working for you for retirement. I just presume you're going to stay there. How much does the rental property, that $150,000 worth of rental property, how much does that spin off in income for you guys?
About $1,500 a month.
Okay, great. That's fantastic. You're working currently. Are you still maxing out your retirement account?
I am.
Okay, great. And is your wife working?
No.
And you got kids?
I do.
How old?
What have I got? 24, 22, 20, and 16.
My God, you are busy. The obligations you have for the kids, have you set aside money for college for them? Or is part of the money of the 1 point, let's call it, 1.5-ish, 1.5?
None of that is for college education.
Oh, great. Fantastic.
Got all that covered and other things, 529s.
Oh, you're
education statement.
Brilliant. Brilliant. When you look at the Social Security estimate, what does your estimate look like if it, give me 65, 66, 67, whatever your full retirement age is?
Gosh, those things come in the mail. And
I know you throw them out, right? It's probably.
Yeah.
How much do you earn approximately?
So this year, my base salary is $160,000.
All right. So the chances are it's going to be somewhere around $20,000. So of the need of $75,000 a year, the good news is you got your rental income. $18,000 might go up, might go down, but we'll call it 18. You got $20,000 will be Social Security. Some portion of that maybe also from your wife will get half of yours. So let's call it $30,000. So you're going to have a good chunk of your need taken care of, your portfolio will be able to fill in the gap. You're going to have no problem. There's going to be one little problem, and that is that if you really do retire at 60, then you can't tap Social Security until 62. And ideally, I wouldn't even have you do that. I would have you wait till your full retirement age, and you would just fill in the gap with something, like you said, a less corporate job, a little extra cash on the side doing something. So what I would say is this. You got a ton of money. You got a bunch of it in some target date funds. You've got some in index funds. I would look at having the allocation look a little bit more balanced. I'm not sure you even need a target date fund. Where are you investing? Through which company?
I'm at Principal. I got Merrill Lynch. I've got Fidelity.
Are you managing your own money, or are you working with a broker?
I'm doing my own.
Oh, so those are through the companies, huh? So what I would say is this. In the accounts, I would want an allocation for someone in your situation that looked about 60% stocks, 40% safer stuff. That could be bonds. That could be cash. Okay? When you look at the target date funds, you have to actually poke into that allocation and look. Every single company has a different allocation for its target date fund. So, for example, you might look at the Fidelity target date fund and it looks like you're 80-20. 80% stocks, 20% bonds. But you might look at a Merrill Lynch one and it's 60-40. So I know it's a pain in the neck, but you really should look at it. And what I would suggest is that you should be in these funds that are more 60-40. Alternatively, you can get rid of all of these target date funds and just say, I'm going to take a stock index fund and a bond index fund and call it a day, and use that and have 60% stock and 40% bond or cash. And if you had that kind of allocation, or even if you like a little more risk, 65-35, and you did that right now, you would basically say, I am trying to defend against something really bad happening. Here's the asterisk. I don't think you have to change that allocation even if the market were to crash. I think that could be an allocation that would take you through markets going higher, but also going lower. And I wouldn't necessarily feel like you have to time to get back in, because in essence, what I am seeing here, Jeff, is that you and your wife have done an amazing job of accumulating assets. You've, in fact, accumulated the assets you need. You don't even need to do any more. What you need to do is to actually protect those assets on the downside. You want to protect what you've worked so hard to accumulate and to save. And if you pull your allocation back in terms of making it a more balanced portfolio, you don't have to worry about putting that $100,000 back to work. And I think that's a more realistic way to approach where we are right now in the marketplace. How does that sound to you?
No, that makes sense. I definitely got some homework I need to do.
Yeah.
Where I am on some of these target date funds and go from there.
Yeah. And then if you really are nervous and you really do want to just say, okay, before I do that homework, I want to put like $100,000 in cash, I'm cool with that. But then put the money back to work. The good news is if you're doing this inside of a retirement account, there's no tax liability. So that's so that's why I think it's fine to do it, at least even in the interim. OK, so let's kind of like get things buttoned down a little bit and protect yourself. And you just keep saving, and life will be very good for you, Jeff. I feel like you're great savers. Our job is to make sure you don't lose it and essentially just get caught up in a euphoria on the upside or get swept in a downdraft. So let's secure this and get a portfolio you can live with in both scenarios.
All right.
All right. Good luck, man. Thanks for calling.
Appreciate it.
Take care.
Bye.
Okay, we will be right back with more of your questions. But during the break, here's what you should do. Go onto the website. Go to JillOnMoney.com and sign up for that free weekly newsletter, because Mark and I have a little bet about how many people we want signed up by the end of the year. And I have a big number in mind. He already hit his. No, you hit your first hurdle, but he wants a bigger number. He wants 5 times what we have now. So go get the newsletter. JillOnMoney.com. We'll be right back.
Follow Jill on Twitter and Instagram for more personal finance content. Just use the handle @JillOnMoney. Now, back to the show.
You're back with Jill on Money. If you've got a financial question, we'd love to hear from you. I'm getting geared up for my vacation right now. I'm just doing some research on how to go away and really take time off. So we'll see if I do it. I'm going to try to disconnect. Well, I'm definitely disconnecting from social media. The question is, Mark has challenged me. He basically said there's no way that I can refrain from checking my email, which may be true. But how about this? What if I only said I'm going to check once a day? What do you think of that, Mark? When would I do that? At the end of the day? Oh, you think in the morning, clear it out, be done. I have a spouse who's impossible. There's no way. But I got to figure it out. Anyway, if you've got a financial question, we would love to hear from you. And our email address is askjill@jillonmoney.com. And if you want more content, we've got a ton of it. Go to jillonmoney.com. You can listen to past shows. You can listen to part of this show after it's been heard on your local radio station. You could read, listen, watch, sign up for our free weekly newsletter. How about that? Tom writes, I enjoy listening to your Saturday afternoon show and your Monday morning financial update on Hartford's WTIC radio. I love WTIC. Very powerful station. And great listenership. Anyway, Tom says, I always learn a lot. Thanks, Tom. Tom's a good saver. And he writes, from the time our 3 sons were born, I aggressively saved for their education. We also had good returns on the investments, combining 529s with growth mutual funds. Now our youngest is starting medical school. Oh, my gosh. And we have just the right of money to pay for all 4 years. But I am concerned that market volatility could take away some of its value. And I don't want to completely give up on the possibility of further growth. Do you think it would be wise to move half of it into a secure investment like a money market fund? Or should we move all of it? Is there a better place than a money market fund? I'm sure there'll be a capital gain when we do this, so the taxes will eat into the value. Because of that, is it better to sell the smaller chunks of the growth fund each year to keep the gross income lower despite the risk of loss of value? And do we need to pay estimates when we cash that in to avoid interest and penalties at the end of the year? Well, let me start by saying this. When you lose money that you know you're going to need, you are losing 100 cents on the dollar. When you pay taxes, you're paying some fraction of that. And your long-term capital gains, you didn't say how much money you made, but the most you could be paying in long-term capital gains is 23.8%. So compare the risk of losing 100 cents on the dollar or 24 cents on the dollar. Now you know that is why investment advisors and financial planners will always say, do not let the tax tail wag the investment dog. From my perspective, you know you are going to need to use this money. I would at least sell half of it right now. You got to pay tuition. You need the money in the next year. You don't even need to go into a lower risk fund. What I would probably do is sell at least half of it so you've got 2 years ready. And of the other half, I would ratchet down the risk. I would take the 3rd year and maybe put that into maybe a stable value fund. You know what? Maybe I would just put it into a balanced fund. Maybe I'd do that. But man, I would be selling this thing because I just would want to know I have the money. Mark, do you want to keep some of it at risk? You want to keep year 4 at risk? He's not sure. He and I are such wimps. Because you know why? It's very hard to take risk when you know you have a finite time horizon. That's the problem. I guess that I would definitely put half of it in a money market or a stable value fund. Maybe I'd put a quarter of it into a balanced fund, and the other quarter I'd put into a short-term bond fund or maybe an intermediate-term bond fund. But don't worry about the taxes. Just factor the taxes in. And you've done the hard work. You don't want to lose this money. You just don't. Be careful. Steve writes, thank you for addressing annuities on a recent episode. I wonder if the aversion to using annuities is from the perspective of the accumulation stage of investing. What about the perspective of a retiree who wants to convert accumulated savings into regular monthly income? Yeah, I mean, that you make a good point. We interviewed a retirement expert who really gave us a ton of data that show people like monthly income. And, one of the things that's really important is that that income is hard to generate on your own. So, okay, I get that. All right, let me go back to this. Steve writing that some advisors say a safe withdrawal rate is something in the 3.5% range. Why not take a portion of the savings, convert it into annuity, which will pay a monthly income of over 6%? Because you're not getting monthly income of over 6% once you actually factor in the prices. That's my guess. I've also heard financial advisors say it's bad to purchase an annuity inside of a tax-deferred account because of the cost. You're saying you can withdraw 6% a month. Where can you get a guarantee 6% a month after you've factored in your costs? I think that it's great if you want to. He's going to purchase an annuity with a third of his savings. We'll give him monthly income combined with Social Security and rental income that's sufficient to pay all of my living expenses. I want to be sure I'm not missing something. 6% is greater than 3.5%. I'm struggling to understand why a person who is in the decumulation phase shouldn't consider annuities. Also, by the way, one of the reasons why? Because when you get 6%, your money's gone at the end. The 3.5% presumes you preserve your corpus of your investment, that your money lasts a lot longer. Anyway, it sounds like you really want to buy an annuity. And I'm not sure the math works when you put them side by side and you factor in the cost of the annuity based and the fact that you've now given the money over to the insurance company. You've lost control of that asset. That's, I think annuities can be great. It can give you lifelong income. Just got to make sure you're very careful. And I would get an unbiased third party to review that. And I probably would make sure that unbiased third party was not just a fiduciary, but a fee-only advisor, someone who does not take a commission on anything and really can give you an analysis that's in your best interest. Thank you for writing. Hey, have you checked out our sister broadcast? It's a podcast. It's called Better Off. You can subscribe to it on Apple, Stitcher, Radio.com, Google Play, anywhere else you find your favorite podcast, or just go to JillOnMoney.com. We'd be happy to do it for you right there. Okay, when we return, more of your questions. We will be right back.
Back to Jill on Money with Jill Schlesinger. Have a question? Call or email anytime, 855-411-JILL, or ask Jill at JillOnMoney.com.
You're back with Jill on Money. Have you subscribed to our free weekly newsletter? You should. Just go to JillOnMoney.com and subscribe there. Check it out. JillOnMoney.com. Okay, Margaret writes, we currently owe approximately $47,000 on a home equity loan, and we're paying about $200 a month interest. As you well know, interest rates continue to rise. And given the new tax law, we may not be able to use that interest as a tax deduction. Kind of depends on what you used. If you used it for home improvement, you can. If you used it to pay off other debt, you can't. Anyway. Would it be more financially beneficial for us to pay off the home equity loan from our savings account instead of continuing the monthly $500 we've been paying? We have more than enough in our savings account to pay it. Our mortgage will also be paid by the end of the year. Our savings account is currently earning about 1.5%, and we're getting about $125 per month in interest. Want to reverse engineer that for me? They're getting $125 a month in interest on that account? How much money can they have? You know what I'm saying? All right, let me just say this. Pay off these loans. Just be done with it. Because it sounds to me like you have so much money that's set aside in your savings account that I would absolutely, positively, maybe I'm wrong, but I wonder if you're telling me that you're getting $125 a month in interest on your account, and the account's earning 1.5% interest. That tells me you got a lot of money in savings. So yes, absolutely, go ahead, Margaret, pay that sucker off, that $47,000, And yeah, why not pay off the mortgage that's going to be done anyway? And I know that those rates are higher than the rate you're earning in your checking account. So I'm saying, let's do it. Now, everyone else listening, before you go nutsy Fagin and start paying things off, that's not advice necessarily for you. This is advice for Margaret, because Margaret has a lot of money in savings. For most people, you don't actually have that latitude. You don't have enough money in savings, so you're not able to do it. All right. Thank you for writing, Mark. Okay. Margaret. Thank you for writing, Margaret. I'm looking at Mark. I'm saying Margaret. Okay. Here is a note from Linda, who enjoys reading our columns in the Chicago Tribune. And she said, my husband and I are raising our grandson, who is 13. We are his legal guardians. We plan on sending him to college. My husband is still working, and we have a good deal of savings. I read that these plans are figured differently when held by grandparents rather than parents. We could never turn over funds to his parents because of their serious issues. Can you shed light on this or tell me where to find more information? You know, I don't think that would be in your situation because you are legal guardians. And I think that would be something that is different than whether, because you have responsibility for raising him. What's likely to happen is you would have to write a letter when he's applying for college to explain that you are the legal guardians and you would be the owners of the account. He would be the beneficiary, and those funds would be assessed at a different level as the guardians of that child rather than as the grandparents. Because what it would mean is that it would be assessed, I think you knock off like 5.64% or something like that when it comes to financial aid. So that would be the difference for you guys. If you're really worried about the whole 529 plan issue, Linda, what you might do is then just, have money that's set aside in a brokerage account. Maybe that's a safer way to do it. But I do think what you ought to do is go to savingforcollege.com, look up your plan wherever the state of residence is. And since you're reading the column in the Chicago Tribune, I'm thinking you're Illinois. And see if there's some information for you on that. That's what I would do. Check out savingforcollege.com. Okay? Thank you, Linda. Can I do one more, Mark? Okay. Quick. Okay. Here's a question about from Karen. Retired. My money's in a 401k. Should I roll it into an IRA and why? Well, depends. If you have a good plan and it's cheap and they allow you to stay there, you can just stick around and keep the money in the 401k, Karen. But if the plan is forcing you to leave, because some plans do that, you then move into an IRA rollover. Or if you don't like the choices within your current 401k plan, you would roll it over to an IRA rollover, hopefully at a nice cheap place like Vanguard or T. Rowe Price or Schwab, someplace like that, TD Ameritrade. And then you've got the entire universe of their funds available to you. If you need more information or more help with this process, just give us a holler. You can do that by sending us a follow-up email. Our email address is askjill@jillonmoney.com. askjill@jillonmoney.com. Hey, check out our website, jillonmoney.com. You can read, listen, watch, and sign up for our free weekly newsletter. Okay, we'll be right back with more of your great questions. You are back with Jill on Money. If you've got a question about something going on in your financial life, it could be anything. Maybe you are even considering a job change. and you want to compare your benefits with your new benefits, give us a holler. Just send us an email. Ask Jill at jillonmoney.com. Javier wrote in after I put a post up on LinkedIn, which was about the trade deficit. Anyway, Javier is currently working as a consultant in Warsaw, Poland. He's originally from the north of Spain. And his question is, in your opinion, which of the involved parties, the U.S. or the EU, is losing or winning the most with new trade tariffs? What's the most immediate impact on the European Union economy in the short term? I don't think either side is going to win anything. I think both sides are going to get hurt. And I think the most immediate impact would be that the European Union's GDP is slightly less than it had already been. I think that there are certain parts of the EU that are going to be harder hit. Like I think Germany's going to be harder hit. But I think both sides lose. And the immediate impact is that it shaves off some fraction of growth. So maybe let's say every full-blown crazy trade war, everything. Tariff on every single good, service, everything for every country in the world. I think in that instance, you might see growth in the United States drop down from the current pace, which is expected to be about a 3% pace for the whole year. I think that would go closer to 2.5%. And in the European Union to be in the ones. It's just a bad situation overall. I can't tell you that there's, like I said, no winner there. None at all. All right. Stay tuned. More of your great questions are coming up next hour. It's Jill on Money. Hop onto the website, jillonmoney.com, and you can sign up for our free weekly newsletter. We'll be right back.
It's the weekend, and that can only mean one thing. You're listening to Jill on Money, the show that takes the mystery out of your finances. Here's your host, Jill Schlesinger.
Welcome back. It's hour number 2 of the program, so it's time for our interview segment. And here we are. It's the end of August, and a lot of kids going back to college and have gone back to college. My niece went back like last week. And so I don't know. August does not seem like the time you should be going to college. It's all about September. Anyway, your kids are heading back to school, or maybe you're starting to take those high school kids on tours. Maybe it is time for a refresher on 529 plans. Now, what's interesting is that, experts on 529 that we've had on the show have been more personal finance experts. You've heard Kelly Peeler, who we love. She's a great guest on the program. Beth Kobliner's been great. But we've never really had someone who consults these big plans. And that's why we're bringing in Andrea Feirstein of AKF Consulting. She is going to give us a different snapshot of the 529 plan. Here's our interview with Andrea. How did you experience the 529 plan landscape? How did you get involved in this?
So interesting. So I come from a municipal background, and a number of my clients in the late 90s were starting 529 plans. So people like treasurers of states. And they would come to me and they would say, can you help us? I was at Smith Barney at the time, and I didn't know the first thing about asset management. But the firm finally decided that they wanted to get involved in this field. They had to do it because people, professional financial advisors needed to help their clients use this brand new product. So I started the 529 business for Smith Barney and Citigroup.
At that time, a state comes to you and says, we want to construct a plan. But you're working for Smith Barney, which is a cumbersome, expensive money manager. What could you offer a state?
Well, what we offered a state was the ability to really provide the entire plan. So to do record keeping, investments, advertising, marketing, really helped a great deal with outreach and trying to get the message out across, admittedly, what you're saying, this more affluent population who use Smith Barney for financial advice. But the states learned early on that what they could do with firms like ours was say, we'll give you the ability to sell your product through your brokers, but you also need to make the effort to sell the product directly to the public. And that was a real departure for firms like Smith Barney and Merrill Lynch, for example. But the states really came to demand that and to expect it. And today, when we look at where the market is, Jill, there are 90 plans offered across the country, 90 different plans. 60 of them are offered directly to the public. 30 are offered through financial advisors.
We're going to get to that in a second because I'm very bearish on that 30.
Okay.
Because I feel like it's a complete waste of money. But I'll get to that in a second.
And the market's proved you out on that.
I know,
right? In a little bit of a way, yes.
So let's start with the basic construct of a 529. Formed in the late 90s out of I guess there were prepaid tuition plans always, right?
Absolutely. And interestingly enough, it was the states that recognized first the real need to help American families save for tuition that was just increasing at astronomical rates in the late 80s. So you saw states like Michigan, Kentucky, Florida create these prepaid plans in the late 80s. It was those states that really led the way for, interestingly enough, Senators Graham and McConnell to jointly sponsor Section 529 in 1996.
So the plan is created, and essentially you can put money in.
Correct.
It grows without current taxation at the federal or the state level.
Right.
And when you take the money out, presuming that it's for what's called a qualified educational expense, there's no tax on all the accumulation.
That's correct.
And the only whacking penalty you get is if you don't use, like, oh, well, my kid Mark got a 4-year cello scholarship and I have no other kids. So now in that case, I get whacked with a 10% penalty on money coming out?
Actually, in that case, you don't, Jill. If you're lucky enough that your child has that cello scholarship, you won't pay the 10% penalty on the earnings. In fact, if your child, if unfortunately something happens, if he dies or becomes disabled or wins a scholarship or goes to one of the U.S. military academies, you're exempt from the 10% penalty on earnings. You will pay income on the earnings.
Right, because then
but it's penalty free.
So the only penalty that is levied is if you just yank it for no reason.
Correct.
Like you needed the money.
Correct.
Okay.
Correct. But one of the things, in a way, the offset to that is sometimes people are scared if they put money in, they'll never be able to get it back. For example, traditionally, people would give newborns a check, right? Or bar mitzvah, you get a check. Confirmation, you get a check. When that check is written to the child, it's that child's money. You can't take it back. You set up an account, we call those UGMA accounts, Uniform Gift to Minors. That account, it belongs to them. If that child decides they don't want to go to college, it's their money. They can go off to the
18,
circus.
Big time.
The incredible thing about 529 is that the account owner always has the right to take the money back. And that gives comfort to a lot of people. It gives comfort to grandparents, for example, who, if one grandchild doesn't go, you can shift the beneficiary to another one, or, you can take that money back in the event of an emergency.
So let's just play that out for a second. So I'm a grandparent, you're my granddaughter, and I put the money away for you. And can I move the money between, say, a different family, like cousins, or does it have to?
Absolutely.
So you can do it among the whole next generation would
Correct.
be the pool of possible. Okay,
Correct.
That's fantastic.
It's a very broad definition of member of the family.
Okay. So now there's a couple of extra benefits. Some states, like the great Empire State of New York, where we are sitting right now, will offer a state income tax incentive.
That's correct.
How many of the states will do that?
35 states.
Wow.
Including the District of Columbia. But that tells you something. That tells you that those states recognize as a policy that this is something we want to encourage people to do.
Even if your state does not actually offer a state income tax deduction, like I don't think California does,
It
right?
does not. Nor does Texas.
So you live in California, you live in Texas, you're listening to this. You don't have to use your plan of that state as long as it's not the prepaid tuition one. If it's the college savings plan, then you can go to any other state.
Correct.
And there's no residency requirement.
That's correct.
And there's no restriction on where your kid could go to school.
That is absolutely correct. But can I add one thing?
Sure.
Just for those listeners in California and Texas, I would tell them, even though you don't get a state tax benefit, look at your state plan because there may be other benefits. For example, you may get protection in bankruptcy from creditors. Your account may be protected within that state. Your account may be exempt from financial aid considerations by the financial aid entity in your state.
Oh, that's interesting.
Yeah, another good example, which is sort of a fun one, New Jersey. If you've saved for 5 years in the New Jersey plan, you may be eligible for a $500 scholarship from the state of New Jersey. It's really worth it, even if there's not a straight tax deduction or tax credit. It's worth it to always start with your home state first.
Okay, we'll get back to our interview with Andrea Feirstein in just a moment. If you've got a financial question, maybe it's a college funding question, maybe you've got a 529 plan, maybe you've got one of those weirdo You Promise accounts. They're not really weirdo, but a lot of people have questions about them. Let us know. How can we help you out? Just send an email. Ask Jill at JillOnMoney.com. We'll be right back.
Have a finance question? There are many ways to reach the show. You can call anytime at 855-411-JILL, send an email to askjill at JillOnMoney.com, or tweet a question on Twitter using the handle at JillOnMoney. Just use the hashtag AskJill.
It's so easy. It's so easy. Just get in touch with us. Come on. We'd love to hear from you. We get a lot of questions about saving for college. That's why it's so great to have a guest on the program who can talk about 529 plans, the ins, the outs. Do you need to be a resident of the state? Do you not need to be a resident of the state? There are actually some plans that have requirements. They're very interesting. Is there something you need to know about your specific plan, especially for the people who are choosing about a plan and maybe you don't have a state income tax credit? So let us know. Here's more of our interview with Andrea Feirstein. Do you still do consulting for all these different states? You're doing for the administration side. So I can't have you trash a plan from a state because it could be a client, right?
It could be.
Okay, let me tell you. Let me do it then.
But give me the story.
Okay. So there I am. I was with friends of mine who had young kids, and the husband says to me, oh, this is probably in early 2000s. Oh, my guy at da-da-da investment firm told me to invest in a 529 plan. What do you think? I said, oh, I love them. So great. Fantastic. It's a New York State resident. Mm-hmm. I said, so great. Fantastic. I said, so you know about the state income tax deduction? And he said, what?
Yeah.
And I said, the state income tax deduction. He said, how could I get a state income tax deduction? I didn't know about that. I said, wait a second, what plan are you invested in? He said, I'm invested in the Rhode Island plan. Now, I happen to have done business in Rhode Island, and I knew for a fact that plan sucked. And it was a terrible, all 529s are great. So all things being equal, if you had to just do nothing or be in a crappy plan, you're probably better off in a crappy plan. But the Rhode Island plan did suck at the time.
In its prior version. It's a new plan today.
So it was an old plan.
To its credit.
And it was, I can't remember who was the investing house, but it was terrible. And it was very expensive. And so there were two levels of fees that this guy paid for. Mm-hmm. One was he had to pay higher ongoing expenses, but he also bought it through his broker who charged a commission.
Right.
And guess what? He didn't get the state income tax deduction because he had purchased a Rhode Island plan.
Unforgivable.
Right?
Yes, absolutely unforgivable.
So that's the kind of thing that makes me insane. Mm-hmm. And what I really have been preaching on this show is when it's all possible, please, number one, take advantage of whatever state plan you have. As you said, there are many advantages, more than I even knew about. And number two, try to go direct because
Correct.
there is no real benefit.
Correct.
I mean, I get that some people would say, like, oh, I just want my guy to do it. I just want my gal to do it. I just want, like, I don't want to actually. But in essence, it's just not that hard
Correct.
to open up an account.
One of the greatest misconceptions about 529 is that it's so complicated and I don't understand investments. I really, I don't know where to begin. And it's kind of like a deer in the headlights a little bit. But the reality is, Jill, the greatest thing that I see from the landscape perspective when you talk about where I began and where we are now, in the early 2000s, I would tell you probably till about mid-2000, 60, maybe 70% of the assets and accounts were sold through brokers, selling plans just like the one in Rhode Island to people who were living in New York, forsaking a $10,000 tax deduction for a married couple in New York, one of the highest tax rate states in the country. But something started to shift. And when we look at the change, the direct sold programs became simpler to understand. Most of the direct sold programs moved away from active investment management to indexed funds, Vanguard indexed funds. So what did that do? It lowered costs. It made it simpler for people to understand, and people felt comfortable. Who doesn't feel comfortable with Vanguard, America's brand? Not trying to sell Vanguard for you, but that's what we saw. So you saw this lowering of the fees, this simplifying of the options, and lo and behold, by about 2012, more than 50% of the assets and accounts in this country today are in direct sold plans.
In your estimation, because you're both a parent and an advisor, what are the good resources that people can use to try to compare these plans? For example, if I live in New York, I'm going to get a plan and it's a directly sold plan. I'm not going to have that many options. But for someone who doesn't have a state income tax deduction or doesn't have great benefits, how do I look at the costs and the options and the fees?
Sure.
What's a good place to go?
Sure. So there are two resources that I think of. One of them is the College Savings Plans Network. Actually, it's collegesavings.org. That is the association of all of the plans in the country and all the plan administrators and the providers. And they have a comparative tool on their website that you can compare features. And, you can look at your plan in your state and then pick a number of other plans. Savingforcollege.com is always a go-to source. But I would look at theirs. They have a very good comparative tool. But then I would go look at the underlying documents and just make sure that...
Because that's fun.
Yeah, that's a lot of fun.
That's so awesome.
When you can't sleep at night.
Right. And I'm worried anyway about my life.
Yeah.
This is a good time to do it, right?
Exactly. And, interestingly enough, and you've pointed this out in the past, I think FINRA, the regulator for broker-dealers around the country actually has a comparative tool. And if you really want to get into the weeds, you could go to the SEC website as well. But stay away from that.
What could be more fun than that? So as you look at this, we have the plans themselves, the state-level plans. What if you do live in a place where you can do prepaid tuition? My high school boyfriend, John, lives in Florida, and he did one of these prepaid tuition plans. Yeah. He's so psyched. He's
the mother of all plans.
He literally said to me, it's the best thing that ever happened to me. Can you explain what some of those plans are like and how they work?
Sure. First of all, there are only 12 prepaid plans that are open to the public. 11 of those are run by states, but one of them, interestingly enough, is run by a consortium of about 285 private colleges.
Really?
So it's a private college option, which is kind of interesting because I look at the breadth of universities and institutions in that plan, and my goodness, there's got to be a school for somebody in there if you want to prepay a tuition plan. So the schools range, for example, from Duke to Princeton to I think it's WashU may also be a part of it.
Which is very problematic because no one can get into these schools.
Well, that's true, too. I acknowledge that. But it's hopeful. It's aspirational.
Yes.
So we want to think that our 2-year-old is going to go there. So that's an interesting one. But going back to the state ones, which is what you asked about initially, 11 states run plans. The downside, let me start with the downside, not wanting to be negative.
Okay.
The downside is if your child doesn't go to one of the schools in your state, you can get your money back, but you may lose the benefit of the bargain. What you're counting on when you go to the university, you enroll in the Florida plan, is that if your child goes to the University of Florida, Florida State, or any number of public institutions in that state, your tuition bill is covered. You've prepaid it, you're done. If you don't go, then you're going to get a redemption value, like a refund value. Every state calls it a different thing, just for yucks, to make it easy to understand all of them. And you have to understand what that's going to be. So, for example, in the state of Virginia, fabulous public schools. If you take your money out of your prepaid plan, you're going to get back a commercially reasonable rate of return, which is often a money market rate of return.
Oh.
You pull your money, you decide not to go to one of those private institutions in the private college plan, you'll either get 2% earnings or 2% loss in earnings. There's a up to, down to cap on what you get. So what I always say to people is, if you have great public schools in your state, it is a fabulous option. But just beware that you may not, if your child is lucky enough to get out and go to Duke or Harvard or wherever it is, you're not going to get the full tuition equivalent of what you might have gotten at that great state school.
Interesting.
You're going to get some value. And as I said, it drives me a little crazy. Every one of these plans defines it differently. There's a nuance to every plan.
Okay, we'll get back to our interview with Andrea Feirstein in just a minute. But here's something you can do during the break. Go to JillOnMoney.com, click on the resource tab, and then click on something that says 529 plan information. Click, and you'll find out about what's going on in your state. Okay, we'll be back in just a minute. Just hop on to JillOnMoney.com.
Follow Jill on Twitter and Instagram for more personal finance content. Just use the handle @JillOnMoney. Now, back to the show.
When the tax cuts were enacted at the beginning of this year, we did a whole bunch of stuff around that. But you probably forgot about it already. And now you're wondering what's going on with how the tax law may have actually impacted the 529 plan rules. It's time for a back-to-school refresher, because there are some really interesting changes. Specifically, now many Americans can tap 529 plans for their kids' private high school. Who better than our guest, Andrea Feirstein, who is a big consultant to all these big 529 plans, with her firm AKF Consulting. Who better than Andrea to kind of walk us through what's going on with 529 plans after the Republican tax changes went into effect this year. So here's more of our interview with Andrea Feirstein. Let's get into a little bit of some of the changes that have occurred after we had tax overhaul, or tax changes, I should say. As of 2018, you can now pull up to $10,000 a year out for K through 12, private, parochial, charter school, whatever the expenses are that are qualified. Was this a surprising development that you saw?
Yes, I would have to say that it was. And I also want to be clear that it is tuition only.
Right.
So what's interesting, there's another savings vehicle out there, which I know you've talked about in the past, Coverdell accounts. You could use a Coverdell account. You could always use a Coverdell for K through 12 expenses beyond just tuition. It could be for uniforms. It could be for books, for transportation.
But you can only put $2,000 in a year?
Only $2,000 in, and there's an income limitation. So interestingly enough, what they've done now is they've said in 529 you can go to $10,000, which is way more than you could do on the Coverdell. No income limit, but it's tuition only. Now, here's the nab about it, though. Not every state has agreed to recognize it.
Yeah, what's up with that? Yeah. I don't get that. So has New York agreed to it?
They have not.
Okay, so you're in New York, and before you pull that money out to pay for Spence or Chapin or wherever you're sending your lovely lady, your lady child, what do you do? Should you just don't do it? Essentially.
Well, I think I would probably call the state program and ask them what they'll do, because what's going to happen, your earnings, you have a right to take it out from a federal tax perspective. Nobody can tax the earnings on that withdrawal when you take it out, but it's the state that's going to differ. And what the state of New York has said is we haven't decided what we're doing. We're not going to treat it as qualified. So the other complication in a state like New York, as we talked about the New York tax benefit, is that in those 35 states that offer tax benefits, usually if you make a non-qualified withdrawal, you have to realize that withdrawal as ordinary income.
Oh.
So a little unclear here in New York, given that it's not qualified, if you take that money out and you put it in and took a state tax deduction when you put it in.
Not good. You're going to have to recapture that. That's
so,
interesting.
It's really a policy issue, though, I think.
But so you're probably plugged in with all these people. And so do you think the trend will be for them to piggyback onto the federal rules?
It depends on how vocal the public is. I really think that's what it'll be. I think the states that haven't embraced it yet are holding back because of the potential hit on the tax base, right? Like Illinois, Iowa, New York, big hit on, it's a big tax expenditure. If you think people are going to start putting money in, like December 31st to take the tax deduction and then yanking it out January 5th to pay the tuition bill, right? You've lost a lot of money. The other interesting issue is that Congress, I think, is not done with this yet.
Really?
Yeah, one of the funny twists and turns in the November and December tax overhaul was that there was an effort to include homeschooling.
I know, that was the Ted Cruz part, and then they dissed him at the last second.
They dissed him on a procedural issue.
Right.
Which says to me, it's not gone yet. It says to me it'll be back. And I think that that's something that we have to just be aware of. And so there may be more pressure on these states.
But you still think this is a great plan to use regardless of whether you get your state income tax deduction or not. Although my sister's like, oh my God, thank God all of our stuff is the kids are gone. We got it. So I was on a network and an anchor said to me, you always extol like how great these are. You write about it, you talk about it, but isn't this really just a gift to rich people? What's your answer to that, Andrea? Come up with a good answer for me.
No, I think there's a perception that it is a tool for affluent people. But here's what I would say. I would say that the states have made a real concerted effort to do a outreach to middle and lower income Americans. Now, lower income Americans, are still struggling with how to put food on the table and pay their rent, and I recognize that. But there's an aspirational component to it. So what we see is that we see a number of states or cities or towns creating child savings accounts, right? Child development accounts, which is a wonderful thing for that lower income bracket because it sort of puts them into the thinking of why you save for college. For middle income Americans, I think that the states are trying to do matching grants. They're trying to do programs that incentivize you and really are very aware of the need to get the message out, because that's the bulk of people that we need to start to save, to understand that you don't have to save a lot. You don't have to save. You don't have to be able to put $5,000 in. You could take $10 a week. Put the money in a 529 account. Do it slowly. $10 a week. Just get on an automatic plan. And that's what I think the message is that's coming from the direct plans. They're trying to get that message across because one of the things we see is that when a child knows there's money there to go to college, they think differently about it. When a family gets in the regular habit of saving and they understand the importance of this for their child's future, they'll do it. So I think there's a broad outreach to that middle income bracket, and I think as we start to hit that bracket, penetrate it more, we're going to see people relying less on student loans and young children in America having a better future overall.
Thanks so much to Andrea Feirstein for joining us today. If you've got more questions about 529 plans, saving for college, maybe it's something completely different. I don't care what the topic is. If it has anything like a $ attached to it, ask Jill at JillOnMoney.com is our email address. And we will be right back to answer more of your financial questions.
If you've missed any part of the show or want to check out a past show, go to JillOnMoney.com for more great personal finance content.
You are back with Jill on Money. If you've got a financial question, we'd love to hear from you. Our email address is askjill@jillonmoney.com. If you go to the website, jillonmoney.com, not only can you register for our free weekly newsletter, free, you can also subscribe to our free sister broadcast, our podcast. It's called Better Off, which is awesome. You can get it on Apple, Stitcher, radio.com, Google Play, anywhere else you find your favorite podcasts. What else can you find on Jill on Money? You can find videos, TV segments, old shows, columns, all of it. All right, let's get to some more questions. This is from Corey, who listens to us in Buffalo. I believe that would be on WBEN. Okay, here's the situation. Corey and his buddies have been in a union for the past several years. And recently, one of my buddies started a non-union company that the five of us are working for. We've been paying into an annuity for a bunch of years, and the union hall is telling us that we cannot transfer or withdraw our money because we will no longer be part of the union, but we're still doing the same work. So basically, they're telling us that they're holding our annuities hostage until we're of age to withdraw it, unless we go back to work for the union. It just doesn't seem right. The money that we contributed came out of our paychecks that we worked for. Is this something to do with a non-compete clause? If so, shouldn't it be capped at a certain amount a year? Hope you can answer this for me. We're all really nervous about being able to transfer and contribute more. Two guys had their annuities for 10 years. I've had mine for 7. The others have had theirs for 6 and 4. Thanks, Jill. I hope to hear back from you. These union rules are kind of interesting. Mark, you were in a union, right? Weren't you in the SAG or SAG-AFTRA? WGA, the Writers Guild. The unions each have their own rules. I know that a lot of the folks in the media world are unionized. I am not in a union. I would imagine that if they are telling you you can't do it, then you can't do it. But you said you hold the annuity at Mass Mutual. One thing you might be able to do is talk to Mass Mutual directly and find out whether or not, if you essentially separated from service from your current job and were to move to another job, whether or not you could roll over that annuity. I'm just wondering because, if you're not in a union job, if you leave the union, they cannot keep your money. And you have to have, I agree, you would, no, I shouldn't say you have to. I would imagine you would have the ability to roll it over somewhere. The question is whether they are talking about money that they put in versus money you put in. So I would call Mass Mutual. You know what else I would do? I might talk to a fee-based financial planner who could maybe help all of you together. You could all chip in and help and have somebody talk to the union on your behalf. Because, sometimes they kind of screw with the individual, but when a professional gets on the phone, they act a little differently. So you may want to go to a website called NAPFA, NAPFA.org. Put your zip code in. See if you can get yourself a fee-only person who will help you through this process and maybe help you talk to both the union representative who manages the retirement stuff and Mass Mutual directly. But that does seem kind of crazy. Oh, good luck, Corey. Okay. Here we go. Marcus writes, the holder of my second loan is nowhere to be found and has sent back every loan payment for the last 12 months. That is so wild. Checks are not getting cash. They're getting stale, dated, redeposited into my bank account. The bank has asked me to stop sending checks if the payee is not cashing them. It's a $350,000 loan with 24 monthly payments and a balloon payment in May of 2019. I've never received any correspondence or payment book. I reached out to the hard money broker who seemed disinterested and said the payee may be in China. The second does show up on my title. My first loan is a 30-year at 5.25. My second is at a 2-year balloon at 10%. First has a $500,000 balance. The appraised value is $2.5 million. Should I sell and see what happens when the second payee is not able to be found? Thanks. I love your show. What a wild story. I have no idea. I totally don't know the answer to this. My inclination is that you should probably talk to a lawyer and get some advice, because I think this is now starting to be a legal question. Because what would happen if you sold it and we couldn't clear title? Huh? I mean, like, what? You'd be stuck. So I might talk to a real estate lawyer and get some advice on this, because obviously if somebody holds that note, we don't know who that somebody is, but there is some note that's being held, and maybe there's a legal process that you can get it discharged if you've tried to pay them over a certain period of time and they haven't cashed the checks. That is a wild story. All right, you're listening. Send all your wild stories to us. You're listening to Jill on Money. Our email address is askjill@jillonmoney.com. Our website, same name, jillonmoney.com. And we'd love to hear from you. So give us a shout. We'll be right back. You're back with Jill on Money. If you've got a question, a financial question, just let us know what it is. Shoot us an email. Ask Jill @jillonmoney.com. All right. Let's do this. Here we go. Here's a question. Let's do some mortgage questions. A 10-year versus a 30-year. Vishal is a first-time home buyer, is considering a 10 versus a 30-year mortgage because of the significant amount of mortgage interest that would be saved over time. I'm considering the downsides. Okay, let me just put this very clearly. I like 30-year mortgages. I like 30-year mortgages because it gives you more flexibility. And when you have more flexibility, then you have better choices down the line. So, yes, you could make it a 10-year mortgage if you want to aggressively pay it off, but why put yourself on the hook for that? I wouldn't do it. Nope, I wouldn't. Take a 30-year. We'll go from there. Okay? Isn't that better? I think so. Linda writes, last year was the first year that she had to take required minimum distribution. She was blindsided by tax implications. Short of closing my business, which I would not like to do, is there any way I can minimize the taxes? No. You have to pay required minimum distributions. You have to take a certain amount of money out every single year based on how much money you've saved in your retirement account. That's it. There's no choice about that. I'm very sorry. And finally, here's someone who wanted to know, who wrote in response to an article that I wrote in some paper. I don't know which one this is, but it must have been in the Chicago Tribune. I researched and developed the prepaid tuition program at the state of Illinois, College, Illinois, which is continuing its success. This was when I did my Q&A article, Mark, the various Q&A articles. So this is so cool. Anyway, Donald, thank you for creating the prepaid tuition program for the state of Illinois, College, Illinois. It's continuing in its success. And thank you for making this show a success. We'll see you next week for Jill on Money, if this is the end of the show, which I hope it is. Thank you all for listening. Hop on to jillonmoney.com if you have any questions about anything in your financial life. jillonmoney.com. We've got a contact us button, and we'll see you next week. Bye.